Welcome to the Deep Dive. Today, we're digging into something really crucial. The U.S. Department of the Treasury's recent request for information, the RFI, on artificial intelligence in financial services.
Right. It's all about how AI is, well, fundamentally changing finance.
Exactly. What are the key challenges, the opportunities? How do we navigate this, responsibly?
Well, this RFI, it was published June 12th, 2024. It was a broad call, really, asking for insights on AI use, the potential upsides, and importantly, the risks. And this was across the board, banks, non-bank, financial companies, you name it. The goal was getting a handle on how this tech shift affects everyone.
And not just the companies using it, right?
Yeah.
It was wider than that.
Oh, absolutely. Treasury wanted the impact on consumers, investors, businesses, even the regulators themselves.
So who actually weighed in? Who responded to this?
It was a really diverse crowd. They got 103 comment letters by the deadline.
Wow.
Yeah, financial firms, obviously, but also consumer advocacy groups, the tech providers building the AI, fintechs, trade associations, consulting firms, a real mix.
Okay. So pulling all that together, what's the headline, the main takeaway?
The big picture is clear. AI is already a major player in finance, and it's growing fast. Huge opportunities, definitely. But there's also a strong sense it could amplify some existing risks, make them bigger.
Okay, and I remember seeing something about caution around the newer AI stuff, generative AI.
Yes, exactly. That's a key point. While there's excitement, lots of respondents urged caution, especially about using things like generative AI directly with customers.
Why specifically customer-facing?
Well, a lot of it comes down to the black box issue, It's harder to understand how these models reach decisions compared to traditional AI.
Right, less transparency.
Precisely, and that's a big hurdle when you're dealing with customers. Trust and explainability are paramount there. So, yeah, some definite hesitation on broad deployment just yet.
Got it. So our mission today is to unpack this report, pull out the most important insights for you listening, understand the landscape, the potential, and the big considerations.
Let's do it.
Okay, let's start with the opportunities. Where are we actually seeing AI used right now? What's it making possible?
Honestly, it's almost easier to ask where traditional AI isn't being used. We're hearing algorithms, machine learning. They're in almost every function.
Like what? Give us some examples.
Okay, so compliance, internal operations, underwriting decisions for loans, insurance customer service interactions, managing the firm's own treasury, developing new products, marketing. It's really embedded.
And what about the newer generative AI? You said it's early days.
That's right. A lot of the use cases there are still experimental, kind of testing the waters. But the expectation is for rapid growth. Everyone expects it to expand significantly quite soon.
Okay. So let's nail down some specifics for traditional AI. Where is it really making a difference?
Sure. Credit underwriting is a big one, assessing repayment risk. Trading and investment strategy development, automating trades. Risk management, identifying potential problems. Regulatory compliance, spotting fraud. Money laundering patterns. Customer service chatbots, support automation. And back office functions, streamlining tasks, improving efficiency.
And the generative AI experiments.
Yeah.
What are firms trying out there?
Based on the responses, the main focus seems to be on enhancing existing processes. Risk and compliance was a big one. About a third of firms surveyed mentioned that.
Okay.
Client engagement was another key area, maybe 26% or so. And also software development, helping write code, that kind of thing. Around 24% mentioned that.
Interesting. So those are mostly internal gains. What about uses that affect us, as consumers or investors?
Yeah, there are definitely external-facing uses. Payment providers, for instance, use AI to analyze spending and offer personalized recommendations.
Oh, yeah, I've seen those.
Right, and AI can analyze unstructured data, think emails, social media for customer sentiment or market research. A really important one is using alternative data, like rent payments, utility bills, even geolocation data sometimes. AI can process all that to help with credit underwriting. This could potentially help people without a traditional credit file.
Ah, okay. That's interesting.
And generative AI is starting to be used to understand and respond to customer emails and messages.
And for investors, what's AI doing there?
Well, robo-advisors are a prime example, offering tailored investment advice.
Right.
AI is also driving forecasting insights and automating trading. It helps find patterns, optimize trade execution, manage portfolios, assess risk. Lots of applications in shaping strategies.
What about insurance? Seems like a natural fit for AI.
Absolutely. Insurers are using it across the board. underwriting policies, processing claims faster, detecting fraud, targeted marketing, and risk management.
Risk management, how?
Things like real-time claims analysis, forecasting losses from catastrophes like hurricanes, and speeding up claim payments.
Now, you mentioned helping people without traditional credit files. Can AI genuinely boost financial inclusion?
There's definitely potential there. Using that alternative data we talked about could expand credit access for underserved groups, minorities, small businesses. We're seeing early AI-driven microfinance ideas too. And natural language processing can help with translation or transcription, making services more accessible. Plus, there's hope AI could reduce unintentional bias in things like mortgage underwriting by looking at more objective factors.
Okay, let's swing back inside the firms. What other internal uses are common?
Well, beyond the risk and compliance we mentioned, there's treasury management, enhanced fraud detection, lots of back office automation, record keeping, predictive text for emails, document searching. Cybersecurity is huge. AI helps detect and respond to threats. And in the anti-money laundering, counter-terrorist financing space, AML-CFT AI analyzes vast data, spots anomalies, verifies identities.
And generative AI is helping there too.
Yeah, it's being used to collate data and automate report writing for investigations, also for improving stress test scenarios and forecasting accuracy.
So the overall vibe is AI seen as transformative, better operations, smarter decisions.
That's definitely the feeling from the RFI, yes. But, and it's a big but, alongside all this potential comes a significant set of risks that need serious thought.
Okay, let's pivot to those risks then. You said AI could amplify existing problems. What are the main worry areas?
Several key themes came up repeatedly. First, just the general idea that as AI spreads, we need to make sure our existing laws and rules are up to scratch.
Makes sense.
Then, specific concerns around data, privacy, security, quality, bias in AI, the whole explainability problem, and AI making stuff up hallucinations.
Right.
Also, the impact on consumers and consumer protection. Risks from too much concentration, like a few firms dominating AI. Issues with relying on third-party AI vendors, and the risk of AI being used for illicit finance.
Okay, let's unpack those, starting with data. AI runs on data, right? So what were the specific worries there?
A big one was data quality. Models need good, clean, unbiased data to work well.
Garbage in, garbage out.
Exactly. Security is critical to preventing breaches, but also data poisoning, where someone deliberately feeds bad data to mess up the AI. And then there are questions around intellectual property, data permissions, unauthorized use, who owns the data, who can use it for AI.
And are our current rules enough? Was there agreement on that?
No, definitely not. A lot of debate there. Some argued existing frameworks, like the banking agency's model risk guidance or the Graham-Leach-Bliley Act, GLBA, on privacy, are sufficient.
But others disagreed.
Right. Others felt these weren't designed for today's complex AI, or the fact that non-banks use AI heavily but aren't always regulated the same way. There was even debate on GLBA's opt-out approach for data collection.
Ah, opt-in versus opt-out.
Yeah, many pushed for opt-in, maybe limits on data collection, and the patchwork of state privacy laws complicates things further.
So what solutions were suggested for managing these data risks?
A range of things. Developing specific AI governance frameworks, using privacy-enhancing tech like homomorphic encryption or federated learning.
Can you briefly explain those?
Sure. Homomorphic encryption lets you compute unencrypted data, so you don't expose the raw info. Federated learning trains models across different places without pooling the raw data together.
Okay, got it.
Other ideas included using AI itself to spot privacy violations, better data curation techniques, clearer laws on IP and data ownership for AI, and standards for data sharing, maybe using synthetic data or privacy tech, especially for things like fighting illicit finance and managing international data flows.
Let's talk about bias. That's a huge concern with AI. How did the RFI address it?
The main worry is AI learning and amplifying existing biases from its training data. Historical redlining and lending was a key example. Cited AI could inadvertently perpetuate those bias patterns.
Even if fair lending laws apply.
Yes, because the bias might be baked into the data the AI learns from. Now, there was some optimism, too, that AI could potentially reduce bias by looking at more variables than, say, just a credit score, which some see as potentially discriminatory itself.
What are firms actually doing about bias now?
Many said they have internal guidelines, they do audits, follow ethics codes, look at model risk management guidance.
But is it enough?
Well, some respondents were skeptical. They questioned the effectiveness, noted some mitigation techniques are costly and might not yield huge improvements.
And Explainability, that term keeps popping up. Why is that so critical?
Explainability is about understanding how an AI makes a decision. Many complex models, especially deep learning, are like black boxes. You see the input, you see the output, but the reasoning inside is obscure.
And the problem with that is?
Several things. Reputational damage if the AI makes a bad or unfair call. Potential violations of consumer laws that require explanations for adverse actions. And just general lack of trust if you can't understand the why.
And generative AI makes this harder.
Much harder, potentially. The sheer number of parameters is exponentially larger. Firms also mentioned struggling to get enough info from the vendors who built the models, though vendors worry too much disclosure could create cybersecurity or trade secret risks.
And those AI hallucinations, that sounds worrying for finance.
It is. That's when generative AI confidently states something that's just wrong. It creates new oversight challenges, especially if these systems talk to customers. Inaccurate financial info could be really damaging.
Were there proposed solutions for explainability and hallucinations?
Yes. For explainability, ideas like retrieval augmented generation came up where the AI cites its sources, basically.
Ah, okay.
Also, rigorous backtesting, continuous monitoring, audit trails, impact assessments, risk classifications for different AI systems. For hallucinations, the focus was really on robust data protection and ensuring data quality in the first place.
Okay, let's zoom in on consumers. What were the main concerns about AI's impact there?
It's a double-edged sword, right? Potential for better service, personalized products, but risks too. Opaque data collection, bias creeping in.
Uh-huh.
Fears about worsening inequalities, steering people to bad products, digital redlining where groups get excluded unfairly by automated systems. Accuracy of things like chatbots is crucial, as are clear disclosures about AI use. Firms worry about liability and reputation if chatbots give bad advice.
What safeguards were suggested for consumers?
Things like regulatory requirements for chatbot accuracy, pre-launch testing, maybe even regulatory pre-approval for some customer-facing AI.
Okay.
Strong recommendations for clear, simple disclosures when AI makes decisions affecting people. The debate over data collection continued strong support for opt-in consent, ability to withdraw consent, maybe regulatory limits on data collected.
And handling errors, like if the AI uses bad data.
Disagreement there. Some felt existing rules like FCRA dispute processes are okay. Others called for mandatory human review of challenged data under FCRA. And a strong reminder that existing consumer protection laws like UDAP against unfair practices and fair lending laws apply no matter the technology.
How can bias specifically be minimized for consumers?
Suggestions included baking fair lending principles into AI design, maybe using AI carefully with alternative data to identify credit invisibles, but caution on data accuracy is needed. Third-party compliance checks were also suggested.
Any potential regulatory actions mentioned?
Possibly collecting data on product pricing to spot disparities, maybe prohibiting unexplainable AI that impacts consumers, requiring firms to search for less discriminatory alternatives, though that needs more clarity. Testing for bias is hard without good demographic data that was noted. And some pointed out gaps in existing fair lending laws themselves, like uneven supervision of banks versus non-banks, or limited coverage for some products like bank accounts, which AI could exacerbate. Concerns, too, about imprecise AI leading to things like wrongly closed bank accounts without proper appeals or notices.
Another risk mentioned was concentration. What does that mean here?
It's the risk of AI development getting concentrated in just a few big firms, especially for the most advanced models.
Why is that a problem?
Smaller institutions could be at a huge disadvantage. They lack the data, computing power, investment for cutting-edge AI. This affects competition.
Right.
There's also the systemic risk of relying on a handful of foundational models from a few key providers. If one of those providers has an outage or a problem, it could ripple through the whole system. Some even worried about AI amplifying systemic risk, maybe driving bank runs or unpredictable market herding.
How can that be mitigated?
Suggestions included stronger operational risk management, more support for open source AI to reduce dependency, monitoring provider concentration, and requiring things like gradual rollouts and circuit breakers in AI systems.
Okay, now third-party risk. Most firms won't build all their own AI, right? They'll use vendor tools. What are the risks there?
It brings all the usual third-party risk management or TPRM challenges. You need due diligence on operational, reputational, legal, regulatory, compliance, and data risks, breaches, unauthorized sharing, etc.
But AI adds new wrinkles.
Yes. While existing guidance on third-party relationships was seen as a good start, many felt it needs updating for AI specifics, concentration, supply chain risks, even using third parties for due diligence.
What TPRM techniques were highlighted for AI?
Standard stuff, but applied carefully. Strong governance, ongoing assessments, security controls, business continuity tests, cybersecurity tools, data quality frameworks. A big worry, though, is smaller firms lacking leverage with powerful AI vendors, leading to vendor lock-in.
Right.
Some urged exploring regulatory authority over these third-party providers, maybe via the Bank Service Company Act. Building sufficient internal AI expertise for effective oversight is also a challenge.
Any specific regulatory solutions proposed for third-party AI risk?
Ideas included standards for pre-deployment testing, maybe an FFIEC-like framework for assessing third-party AI, FinCEN and guidance on AI for AML-CFT, maybe standard model data sets for testing. Updating vendor onboarding and monitoring for AI is key. State insurance regulators are already working on third-party data model oversight. Ensuring data quality and validating results is tough when data or models are proprietary or open source. Support for enhanced disclosures like a nutrition label for AI came up.
A nutrition label, interesting.
Yeah, requiring vendors to disclose AI use. Certification programs were floated, but with counter concerns about worsening concentration. And ideas to reduce lock-in, like making switching easier and better supply chain risk management, knowing your vendors' vendors.
Lastly, illicit finance risks. How might AI play into that?
The concern is adversaries using AI more effectively for cybercrime and fraud.
Examples.
Using deepfakes to bypass identity verification, crafting super convincing phishing emails or social engineering scams. Generative AI could, well, supercharge phishing and malware creation.
And defenses against that.
Robust digital identity solutions are key. Things like passkeys with biometrics, multi-factor authentication using risk engines to spot anomalies.
Wow. Okay, that was a lot on risks and mitigations.
Yeah.
Let's shift to the broader policy picture emerging from the RFI. What were the main considerations there?
A big one was the regulatory framework itself. Different standards for similar activities across different types of financial firms using AI is a concern.
Right, the level playing field issue.
Exactly. So there's a strong call for better intergovernmental coordination, consistent guidance, information sharing, aligned governance. Public-private partnerships were also widely supported. People discussed existing frameworks from the Fed, FDIC, FinCEN, SEC, CFTC, CFPB, NIST, how they all fit or need updating for AI.
What about laws, federal versus state efforts?
Big concern about conflicting state laws creating confusing patchwork, uneven requirements, and potential regulatory arbitrage.
Meaning firms might shop for the easiest rules.
Potentially. So there was support for a cohesive federal framework that works with state efforts, especially since there's no single comprehensive federal AI law yet. But states are getting active. Actions in California, Colorado, New York were noted.
And the international dimension.
Crucial, too. Other countries are making rules that affect U.S. firms operating abroad. Risk of fragmentation globally, different rules could mean tailoring AI governance, products, due diligence everywhere, different consumer protection levels, too.
So, summing all this up, what potential next steps did the Treasury outline in the report?
They laid out several possibilities. First, continue collaborating internationally and domestically, G7, FSB, OECD, NIST, financial regulators, industry aiming for consistent standards.
Okay, coordination.
Second, more analysis and stakeholder talks to find regulatory gaps and address consumer harm potential. Evaluating the bank versus non-bank supervision issue, checking if consumer protection laws are sufficient for AI data use, clarifying expectations around bias assessment, and finding less discriminatory alternatives.
Right. What else?
Third, potentially clarifying or adding standards for data privacy, security, quality across financial services. Fourth, reaffirming FSOC's recommendation for Congress to give regulators authority over third-party service providers.
That vendor oversight piece again?
Yes. Fifth, financial regulators should keep coordinating to enhance risk frameworks and clarify supervisory expectations, like how the NIST AI RMF fits in. Sixth, encourage more financial services-specific AI info-sharing data standards, best practices, understanding emerging AI. Seventh, explore ways to support smaller firms in using AI. Eighth, monitor those concentration risks from AI providers. And finally, a reminder for firms themselves to prioritize compliance reviews before deploying AI and reevaluate regularly.
So wrapping up, AI is becoming deeply woven into finance. Huge potential for efficiency, innovation,
Definitely.
but also this complex web of risks data, bias, consumer protection, systemic stability, and a major ongoing conversation about regulation and standards.
That's it in a nutshell. And one stat that really struck me from the report, something like 80% of financial firms are already using generative AI somewhere, and almost all expect to use more AI soon. It just shows the speed of change.
It really does underscore that this isn't theoretical future stuff, it's happening right now.
Oh,
Hopefully, this deep dive gives you, our listeners, a solid grounding in this evolving landscape.
and it really leaves us with that central question, doesn't it? How do we strike the right balance? Fostering AI innovation while ensuring consumer protection and financial stability.
Right.
What are the most critical things for regulators to focus on right now?
A crucial question indeed, something for all of us to think about. If you want to explore further, the full Treasury report is out there, and it's worth keeping an eye on AI regulation news in finance. Thanks for joining us for this deep dive.